We are, what, in the final trading days of 2025, and you can just feel this tension in the market.
It's a tug of war, a real institutional tug of war.
Exactly. And the big question everyone's asking from the pros on down is really simple. Is the Santa Claus rally going to show up this year? And maybe more importantly, where is the smart money actually going?
Yeah, that's exactly what we're going to unpack in this deep dive. We're going to cut through a lot of the noise, the holiday cheer stuff, and look at the hard data.
The liquidity data.
The liquidity, the sector-level reality checks. We're talking a veteran's take on the market as of right now, December 19th.
Okay, so before we get into all the numbers, let's just baseline this for everyone. This Santa Claus rally, it isn't just, a good mood at the end of the year. It's a very specific thing.
It is. Historically, it's defined as the last 5 trading days of the year, plus the first 2 of the new one. And it has a, frankly, compelling track record.
What's the average?
An average pop of about 1.3% over just 7 days. That's a pretty powerful momentum burst, usually driven by low volume and, yes, a bit of that year-end optimism.
And there's a real weight to it. I mean, Wall Street still quotes that old adage from Yale Hirsch back in '72.
If Santa's shale to call, bears may come to Broad and Wall.
It's a stark warning, isn't it?
It absolutely is.
Yeah.
It means this tiny little window, it often sets the tone for the entire first quarter. If we don't get that lift, 2026 could start on a really skeptical, vulnerable note.
And today, December 19th, the mood feels cautiously optimistic.
I think that's the perfect way to put it. The Fed just gave the market a gift, but everybody's looking over their shoulder at tech. They're worried about a correction.
Right. And to understand that risk, we have to look at what we're calling the cage match here. It's these two massive opposing forces. You have the macro tailwinds on one side.
And the sector headwinds on the other.
Let's start with the bull case, the macro tailwind. It all comes back to that old rule, right?
Don't fight the Fed. It's the simplest rule in finance, and for good reason.
And the Fed just handed the market an early Christmas present. What was the specific action?
They cut. The Fed moved the benchmark rate down to a range of 3.5 to 3.75%.
And that's not just a minor tweak.
No, not at all. This is the official signal. I mean, the unmistakable sign that the tightening cycle, the one that's been squeezing credit for years, it's dead and buried. It's over.
So it's a huge shot of confidence, but what's the actual mechanism? How does that cut translate into higher stock prices on a granular level?
It works in 2 key ways. Both are really tied to valuation fundamentals. First, a lower cost of capital instantly improves every single discounted cash flow model.
Or DCF model.
The DCF model, yeah. It's the bedrock of how analysts value a company.
Okay, hold on. Let's make sure everyone's tracking with that. Why does a lower interest rate make a company's future profits look better right now?
It's because you're taking all the money a company might make, say, 5 or 10 years from now, and you're discounting it back to what it's worth today.
Right.
The interest rate is that discount rate.
Right.
So when it goes down, the present value of all that future cash it automatically goes up. Cheaper money literally makes future earnings worth more today.
It's like a non-organic boost to valuations just from the math changing.
Exactly. An immediate boost. That's the first part of the bull case.
And the second effect?
Consumer resilience. We've been watching the holiday spending numbers really closely. And despite all the pressure, the data is tracking slightly above consensus.
So people are still spending.
They are. It suggests the consumer is, battered, but their spending power hasn't completely evaporated. And that gives corporate earnings some stability going into the first quarter.
So if we just look at the Fed cut and a stable consumer, you'd think the S&P 500 should be, ripping to new highs right this second.
In a vacuum, yes. It should be.
But it's not, and this is where that reality check comes in, the bear case.
Exactly. We have to pivot to the bear case, which is dominated by the biggest story of the year, the tech sector. And what we're calling the show me the ROI problem. Like ROI meaning return on investment. Right. The Nasdaq is up, 20% this year? That's a huge run.
Right.
And it's almost entirely on the promise and the hype around generative AI.
But you can't run on hype forever.
Right.
And the sources we're looking at suggest we're hitting a critical inflection point. Some people call it peak of inflated expectations.
That's from that Gartner framework, right?
Yeah, it's borrowed from Gartner. But in market terms, it just means the street is shifting. They're moving from, boundless excitement to demanding actual financial proof.
And are there hard numbers that show this shift?
Oh, yeah. It's the Capex cliff. We all know the hyperscalers, your Microsofts, Googles, Metas, have been spending billions on infrastructure.
Just building out data centers, buying chips. Yeah.
Billions. And now investors are finally starting to ask, okay, where's the revenue to match all that spending? The investment cycle is peaking, but the monetization cycle, it hasn't caught up yet. And that skepticism is starting to hit the valuations of the chip makers, the software companies.
Absolutely. We're seeing what's called multiple contraction. Investors are getting tired of paying, say, 40 times earnings for these stocks. That huge multiple assumes perfect execution, immediate high-margin revenue.
And that's a big assumption given the cash they're burning just to stay in the race.
A massive assumption.
Uh,
So if that ROI doesn't show up in the Q1 earnings reports, these stocks could be in for a very painful correction.
so there it is. That's the risk right as we head into the Santa window. The macro signal from the Fed is a huge tailwind.
But if big tech sneezes because of this valuation problem,
The entire S&P 500 catches a cold.
Mhm.
And there goes your 1.3% rally.
And that raises the billion-dollar question for any institutional manager right now. You can't just sit on cash, not with rates dropping towards 3.5%. The money has to go somewhere.
Right.
So if you see this huge risk in tech, where do you put that capital?
Which brings us right to the big strategy we're tracking, the Great Rotation. This isn't about selling everything. It's about moving capital.
It's a rotation, not a retreat. Professionals are looking for sectors that give them yield, value, and ideally, an inverse correlation to all that tech risk.
And what's really interesting is the three main targets you've identified. They all seem to benefit from the Fed cut, but they also have this indirect link to the AI buildout.
That's the key insight.
I have-
They benefit structurally from cheaper money, but also from the sheer physical demands of AI.
Okay, let's break them down. First up, the most intuitive one when rates fall, real estate, specifically REITs.
REITs are the classic play here. Their valuation is strictly inversely correlated to interest rates. When the Fed drops rates to 3.5%, the dividend yield on a stable REIT starts to look really juicy again.
Especially compared to a government bond.
Exactly. It becomes a safety trade that actually pays you to wait for the market to calm down.
But institutions aren't just looking for safety. What's the specific tactical play inside the REIT world?
The really smart play is data center REITs. This is where you connect the macro liquidity with the tech Capex story we were just talking about.
Ah, so they're the landlords.
They're the landlords. They get to profit from the billions Microsoft and Google are spending on new buildings, but they don't carry the risk of whether the AI models inside actually make any money. They just collect the rent.
That's a fascinating hedge. You're betting on the necessity of AI, but not its direct profitability.
It's a fantastic piece of risk management. Okay, so target number 2, energy.
This one feels like it's driven by geopolitics, but you're saying there's a specific AI link here too.
There is. We all know geopolitical instability puts a floor under oil prices. That's the new normal. But the AI link is pure power consumption. The data confirms it. These new AI data centers are absolute energy hogs.
Just incredible power demands.
Unparalleled. The computing power they need requires a staggering amount of stable, cheap electricity. Our grid is already stressed, and this demand is set to go up exponentially.
So the money moves to the companies that provide the raw materials for the revolution.
It's the ultimate picks and shovels play for the 21st century. The analysis we're seeing suggests that traditional energy companies and even new nuclear plays are just fundamentally undervalued relative to this coming demand surge.
You're not buying a speculative story. You're buying the infrastructure.
You're investing in the thing the entire future economy needs to function. It's a clear demand-side argument.
Makes total sense. If tech needs all this power to justify its 40 times multiple, the smart trade is to own the utilities that sell them that power.
It's foundational. Low risk and foundational.
Okay, so the final rotation target. This is the one that seems a little counterintuitive to me. Small caps. The Russell 2000. Why rotate into smaller, more volatile companies if you're looking for safety?
This is the most technical part of the rotation, but it's arguably the most powerful effect of that Fed cut. It helps small caps disproportionately.
Because of their debt.
Because of their debt structure, exactly. A huge company like Microsoft can go out and issue long-term fixed-rate bonds when money is cheap.
Lock in a low rate for 10 years.
Right, but a smaller company, maybe one that's younger, they rely on floating-rate bank debt. Their interest payments change almost immediately when the Fed makes a move.
Ah, okay. So when the Fed cut rates, the interest bill for thousands of companies in the Russell Index dropped overnight.
Yes, it is an immediate and significant discount on their loan payments. which means it's a massive reduction in their operating expenses.
So if you, as a listener, want that growth potential, that beta, but you're wary of the big tech valuations.
The Russell gives it to you. It's been an unloved part of the market for years, but this Fed action is a direct structural boost to all those highly indebted companies.
This has been a fantastic breakdown, so let's bring it all home. We have the strong macro tailwind from the Fed. We have the very real sector headwind from AI exhaustion. What's the final call for the Santa Claus rally?
The most likely outcome is that we get a muted Santa rally. But, and this is crucial, it will not be led by the usual suspects. The Magnificent Seven, the high flyers who've dominated for 2 years, the capital just isn't flowing there right now.
You called it a breadth rally. What does that actually mean for someone looking at their portfolio?
A breadth rally means the average stock goes up while the giants kind of tread water. So instead of, 5 stocks dragging the whole index higher, you see broad participation from value sectors.
Like the ones we just discussed.
Energy, financials, real estate. It's a really healthy sign, actually. It shows capital is flowing back to fundamentals, not just chasing a narrative.
So the actionable advice here seems pretty clear. Don't chase the high flyers trading at 40 times earnings. Let them cool off.
Exactly. Let them prove that price tag is justified. Instead, focus on the quote-unquote boring sectors, the ones that just got a massive gift from the Fed and have a guaranteed surge in demand for what they sell.
It's a shift from speculating on future applications to investing in the foundational infrastructure.
The energy, the real estate, the debt relief. That's the infrastructure needed to support the whole AI revolution. That's where the smart money is moving.
That shift from promise to power. It's the key takeaway. So here's the thought we want to leave you with. If the first wave of these indirect AI winners are the companies providing the power and the physical space, which sectors might be next? What's the second-order infrastructure demand going to be? Because where this institutional capital moves next often tells you the real long-term story of the economy.